SVB Collapse, the one-pound weekend that saved Europe's startups. Silicon Valley Bank was an American bank built for the technology industry. It lent to startups, held their deposits, and worked with venture capital-backed companies that ordinary banks often considered too young, too risky, or too unusual. This video is about what happened when that bank failed in March 2023, and why a crisis that began in California almost froze payrolls for technology and life sciences companies across the United Kingdom and Europe. The European part matters because many founders were not running broken businesses. They were building software companies, drug developers, climate tech firms, and financial technology startups. Their danger was simpler. The money they needed for salaries, suppliers, and rent was sitting inside a specialist bank whose name had suddenly become toxic, the Rise. SVB mattered because it understood the startup world. A young company might have no profit yet because it was spending investor money to hire engineers, test a medicine, or launch a product. Traditional banks often dislike that profile. SVB built a business around it. It offered ordinary bank accounts, but also venture debt, which means loans designed for companies backed by startup investors. It opened accounts quickly, worked with founders, and connected companies to the venture capital ecosystem, meaning the network of investors who fund high-growth businesses. By the time of its collapse, SVB served nearly half of all venture-backed companies in the United States. In Europe, its United Kingdom business had been active since 2004, and it also had offices or teams connected to Ireland, Germany, Denmark, and Sweden. For a founder trying to grow quickly, SVB was not just a bank. It was a signal that the company belonged in the startup economy. That trust reached deep into Europe. Some German startups used accounts with SVB UK for international business or to avoid negative interest rates at home. SVB had planned to invest more than $500 million in Irish technology and life science startups by 2024. For many European companies, the bank became part of the operating system, and the UK subsidiary looked especially reassuring. Silicon Valley Bank UK Limited was wholly owned by the American parent, but since August 2022, it had its own independent board and separate balance sheet. In plain English, that meant its assets were ring-fenced or kept legally separate from the parent bank. It was not obviously a failing bank. For the financial year ending December 31, 2022, SVB UK reported £88 million in pre-tax profit. Warning signs: the weak point was not in a London office. It was on the American parent bank's balance sheet. During the low interest rate years, SVB had put large sums into long-term United States government bonds, which are loans to the government that pay fixed interest. When interest rates rose sharply, older bonds paying lower interest became less valuable. That problem might sound technical, but for a bank, it was dangerous. If depositors stayed calm, SVB could wait. If depositors demanded money quickly, the bank might have to sell those bonds at a loss. On March 9, 2023, the parent bank announced a $21 billion securities sale and a plan to raise $1.25 billion through common stock, meaning new shares sold to investors. The message was supposed to strengthen confidence. Instead, it told depositors there was a hole to fill. Startups are unusually sensitive to signals from investors. Venture capital firms tell their portfolio companies how to manage risk, and many founders listen immediately because their survival depends on cash. As concerns spread, some investors told companies to withdraw money. That advice may have been rational for each individual founder, but collectively, it accelerated the run. The numbers moved faster than any board meeting could control. On March 9th alone, customers withdrew $42 billion from the American bank. A bank run, in plain English, is when too many customers try to pull out cash at once, and even a bank with assets can collapse because it cannot produce enough money immediately. For European founders, the alarming detail was that the UK bank had not made the same visible announcement. Yet confidence does not respect legal ring fences. If the parent's name was collapsing on Thursday, the British subsidiary could face panic on Friday. The collapse. On Friday, March 10th, United States regulators shut down Silicon Valley Bank. It became the largest American bank failure since the 2008 financial crisis, and the third largest in United States history. Across Europe, founders opened banking dashboards and group chats. Tim Chong, the founder of Yonder, a UK financial technology company, later described that weekend as terrifying because his company had the majority of its cash tied up in SVB. That is the human version of a banking crisis, not a chart, but a founder calculating whether salaries can be paid. The UK subsidiary then suffered its own run. On March 10th, SVB UK saw £2.9 billion in deposit outflows, about 30% of its total deposit base. At the point of failure, it had an estimated balance sheet of £8.8 billion, about £6.7 billion in deposits, and £5.5 billion in loans. On paper, this was still a real bank with real customers and real lending. In practice, confidence had vanished. The Bank of England, the United Kingdom's central bank, announced its intention to place SVB UK into a bank insolvency procedure. That is a formal process for dealing with a failing bank. For customers, the terrifying limit was the Financial Services Compensation Scheme, the UK Deposit Protection Programme. Eligible deposits would typically be protected only up to £85,000. For a household, £85,000 can be life-changing. For a startup with a monthly payroll, it can be one invoice. More than 200 UK technology and life sciences firms warned they could be unable to pay staff. Reports suggested between 30 and 40% of UK startups, employing up to 50,000 people, could be affected. This is why the weekend mattered. If nothing changed before Monday morning, companies that had raised money honestly, hired people responsibly, and sold real products could still miss payroll because their cash was trapped. The British government moved quickly. Chancellor Jeremy Hunt, the UK finance minister, said on March 12 that SVB UK posed a serious risk to the country's technology and life sciences sectors, while also saying the wider banking system was not at systemic risk. Prime Minister Rishi Sunak became very hands-on, and the Department for Science, Innovation and Technology joined weekend discussions. The goal was narrow but urgent: protect startup deposits without turning the whole situation into a taxpayer bailout. Over that weekend, officials used the UK Special Resolution Regime, a framework for handling failing banks. On Monday, March 13th, the Bank of England and Treasury announced the answer. HSBC UK Bank, part of one of Britain's largest banking groups, bought Silicon Valley Bank UK Limited for £1. The price looked absurd, but the effect was enormous. Customer deposits were protected and accessible as normal from March 13th. No taxpayer money was involved. The deal was completed in under 36 hours. Noel Quinn, HSBC's group chief executive, said the acquisition made excellent strategic sense because it strengthened HSBC's commercial banking franchise. For founders, the important sentence was simpler. The money was available. Payroll could go out. Suppliers could be paid. Companies that had spent the weekend gaming out emergency loans, layoffs, and investor bridges could breathe. The impact had not been limited to anonymous startups. Around 16 European technology and life sciences companies disclosed about $190 million in exposure to SVB in the UK and United States. Trustpilot, the Danish review platform, had $36 million held at SVB UK and $18 million in transfer. Zealand Pharma, a Danish drug developer, had deposits of 162.6 million Danish crowns, about $23.4 million, equal to roughly 15% of its liquid funds. Farming Group, a Dutch biopharmaceutical company, had $26 million at SVB in the United States. These examples show why the crisis was European, not just American. A bank failure in one country had become a cash access problem for companies in several others. Lessons. The first lesson is that legal separation helps, but confidence can still cross borders. SVB UK had a separate board, a separate balance sheet, and recent profit. Yet the parent's collapse triggered withdrawals of £2.9 billion in one day. The second lesson is that startup finance creates concentration risk, which means too much dependence on one provider. SVB's strength was also the trap. It knew startups so well that many startups gathered around it. When one bank becomes the default home for a whole ecosystem, one failure can threaten thousands of paychecks. The third lesson is that speed matters in bank resolution. The UK rescue worked because officials and buyers acted before Monday panic became Monday paralysis. HSBC later rebranded the UK banking and debt lending divisions as HSBC Innovation Banking. while other financial institutions, including JP Morgan, expanded services for European growth companies. The fourth lesson is for founders and boards. Cash management is not back-office housekeeping. It is survival infrastructure. After SVB, more startups focused on treasury diversification, meaning spreading cash across banks, money market funds, and other safer short-term places, rather than leaving everything in one account. The final takeaway is not that every founder should become a banking expert. It is that global finance can turn a distant balance sheet problem into a local payroll emergency within days. Silicon Valley Bank's European customers were nearly dragged down not because their ideas failed, but because access to their own money almost disappeared over a weekend. And that is why the £1 sale matters. It was not just a bargain acquisition. It was the tiny transaction that stopped a specialist bank's collapse from becoming a mass failure of European startups.